To the markets now, where offshore holidays have meant a quiet day. The ASX was up strongly with banks and miners back in favour. The Australian dollar's little changed against the greenback. It's up against the pound and the euro. Well, I mentioned the banks there. One of the big four, ANZ, has announced that it is moving into the $18 billion exchange-traded fund, or ETF, market. Investors can use ETFs to track an index or commodity like gold or a basket of assets like shares. Well, ANZ has teamed up with the London-based ETF Securities. The new joint venture will be listing 6 separate securities on the Australian Securities Exchange, including gold, currency and equity ETFs. Well, joining me now is fund manager Roger Montgomery. And Roger, I know you don't like these ETFs. We've talked about them before, but they're about to take off in this market, it would seem.
Look, they already have. And let me be clear, what I don't like about them is that people believe they can stop thinking when they invest in them. You see, the idea that that you can replace investing in businesses that are increasing their intrinsic value over time by retaining profits and employing it at an attractive rate of return, you can replace that whole idea with just an index that goes up and down. Your emotions will go up and down with it. I think that you need to think about what you're doing, and you need an appropriate blend of these products in order to do it properly, but most people don't.
So, but you can go in and out and play with them, as it were.
Well, I think
actively.
I think the risk is that people actually treat the stock market as a venue to bet on up or down, rather than actually seeing it as a place where you can buy pieces of outstanding Australian companies. And we're of the view that there are some wonderful Australian businesses that are listed, and there are also a lot of mediocre ones in Australia. If you're just buying an index without thinking, then you're buying a lot of those mediocre businesses. So that's why the appropriate blend of ETFs is important.
Let's move to this idea of robo-advice.
Because ANZ also announced that they're moving into the robo-advice space.
Yeah. Is this a good thing or a bad thing?
I think it's brilliant. What you've got to understand is that financial advice in Australia, it goes something along the lines of, we'll offer advice to anyone provided you're rich. And that's the economic model that works. For everybody else who isn't rich but would like to be rich, proper advice isn't afforded to them. So robo-advice offers the promise of providing the opportunity to get sound advice, proper asset allocation, proper price reporting, proper everything.
I should ask you, what is it? What is robo-advice?
Well, robo-advice is the idea that you can replace traditional advice models. You can answer a few questions online or on your mobile phone about your age, your risk profile, your expectations and your needs, and a computer algorithm will generate an appropriate portfolio for you with rebalancing and so on. And I think it's a brilliant solution, because what it does, it brings a lot of heavy-hitting mathematics and arithmetic that is consistently applied in an affordable way for the masses.
Great for data mining. I mean, is it personal enough in terms of the advice it can actually deliver?
Well, I think there's a mistake believing that you can personalise the stock market. You can't fit a round peg in a square hole, but a lot of people believe you can make the stock market do that. So I actually think it's appropriate for a lot of people if it's done well. And there is a company in the United States that's captured almost $2 billion in the robo-advice space already. They're capturing it from the likes of Elon Musk and the founders of Twitter and Facebook, and they'll obviously, a lot of people will follow them into this robo-advice space, and it'll take off from there. It'll be slow, but it'll be very big.
My goodness, okay. Now, before you go, warnings for retirees about risk management in their self-managed super funds.
Just looking, there's 3.5 million people in Australia that are over the age of 65. There's about 500,000 self-managed super funds and 900,000 members. If you just take those 500,000 super funds and the members in them, we've worked out using ATO data and ABS data that they are approximately 70% to 81% weighted to property, not only because of the property that they own, but 20% of them have an investment property, and they also have shares in banks, which are highly exposed to property as well. And so we think, given how expensive property is, that's too much.
Stocked in one direction. Right, Roger Montgomery, thank you very much for joining us.
It's a pleasure, Ticky.